Okay, welcome everybody. It's almost a cliche to say that India is a capital-starved country. Actually, it's not capital in general, but risk capital, and particularly equity capital, that has always been short. Our businessmen have traditionally been either traders or money lenders, mostly banias. See, a trader is primarily concerned with rotating his capital fast, which is enabled by high stock and inventory turnover. Similarly, money lending capital is equally risk averse, which also accounts for borrowers being charged usurious interest rates as compensation for risk. So this risk aversion, it also manifested itself when Indian capitalists forayed into industry. So say if you have a project which is costing, say, 90 crore, about 60 crore used to be financed through debt, and the balance 30 crore through equity, basically 3:1. So, and even out of that equity, 30 crore equity, the promoter's own contribution was, maybe 40%, so which is basically around 12 crore. And in the old days, when you had managing agencies, when they held sway, even 20% equity stake was enough to exercise control, So effectively, by putting in 6 crore, you could float a company that was implementing a 90 crore project, And the promoter ensured that the company's shareholding was widely dispersed so that nobody else could accumulate a sufficient block of shares to threaten his position. And the shareholders didn't mind handing over such sweeping control to the promoter or the managing agency, so long as they received a steady stream of dividends. And there was also stock appreciation. You get more dividends, your stock also appreciates. But now we have a new animal called the venture capitalist and private equity investor. This guy is willing to invest equity capital that does not seek any immediate returns. And what is more, he doesn't seem to be minding that the companies in which he's investing, they themselves are seeking huge valuations. And these are mostly startups that, you forget paying dividends or even generating positive cash flows. These are actually burning capital to fund day-to-day operations. And equally interesting are the promoters. Most of them are young, first-generation entrepreneurs, and people with ideas. And unlike Indian businessmen of the late 19th and 20th century, they have investors to back their ideas. So suddenly we find that risk capital is no longer scarce in India. And probably the proof of it is the sheer number of unicorns or startup companies with valuations of $1 billion or more. There are apparently some 47 of them now in India, and as many as 10 have joined this club just in the current year, 2021 so far, whatever, in the midst of COVID, etc. So to enlighten us more on this phenomenon, we have with us Neelkanth Mishra, is the co-head of Asia Pacific Strategy and India Strategist for Credit Suisse. Neelkanth's team has brought out a recent report that has actually identified not 47 but 100 unicorns, and all of them unlisted companies whose operations are relatively below the radar. Some names I found personally very interesting, including there's one IBS software from my hometown, Thiruvananthapuram. So Neelkanth, the floor is yours. Maybe you can give your presentation.
Thank you. Thank you, Harish, and thank you to you, Rohit and CPR for inviting me to speak here. So you're right, this is a very fascinating trend. And before I jump into my presentation, just to give some background. So back in January, in one of the CII Economic Advisory Council meetings, I heard that the number of unicorns in India was growing very rapidly. That from about 25, we could be reaching 35 by the end of 2021. And that set me thinking that, this is a fairly large number of companies, and can we do a much more rigorous job instead of just, random newspaper articles? And so as we started exploring, we were surprised by the sheer number of companies that we found. And I'll run you through the methodology as I do through the presentation. But one very cynical remark or question that someone asked that, for an investigative project like this, 100 is too round a number. So did you bump it up or did you bring it down, right? So did you find more? And you'll be surprised. We actually, toward the end of our project, we were eliminating companies. That this may have got valuation, but I don't think this is worth it. So basically, there are more companies. In fact, after publishing our report, we came across at least 12 companies over and above the recent additions that you talked about that we seem to have missed. So this is a very vibrant landscape, and I think we are in very early stages of discovery and creation of these unicorns. So what I'll do is in my presentation I will there are 4 parts. For those of you who are following it in the business standard, I'm also running a 4-part series. 2 parts are out, 2 more on exactly this pattern. So the first one was a big picture on why and in the private equity thing that Harish talked about. Second is the very broad enabling factors which have driven this. The third, there are sector-specific dynamics which are also equally fascinating, which are very promising as well. And lastly, what this means for the future. Now, see, India has about 340 companies in the listed space, which are $1 billion plus. See, there are many more unicorns than in India, in China and the US, right? So the US, I think, has 300 plus. China has 120 on the score that Harish was talking about earlier. There's 35 odd, which other consulting firms have talked about. We have taken a much broader lens and we have come up with 100. The interesting thing is that in the listed space, there are 2,800 companies in the US, which are $1 billion plus. So if you have 2,800 and you have 300, then there is a certain proportion. In China, there are 2,100 companies which are listed and have $1 billion plus valuation. Of course, they've also had a very strong bull run recently, which has helped. But the 120 odd companies that exist as unicorns is about 5-6% of that set. In India, in the listed space, there are 336 companies, whereas we found 100 unicorns. So the size of the private sector is actually on a relative basis much larger. And this also addresses one question I often get, that for someone who's actually advising investors, the core job is to advise investors in the listed space. Why are you even exploring the private space? And one reason is that I think we are in the early stages of this development, and I think this space is going to be much bigger. And if you're doing macro analysis, if this is where a lot of the business activity, a lot of the entrepreneurship is getting created, then this is the space where we need to focus. So the interesting thing is that this is also a very diverse set, right? So this is not just your regular e-commerce companies, your food delivery, mobility, fintech, edutech. These are all known segments where there are a lot of headline creating names. But you can see that there are names in healthcare, there are names in industrials. There is a company that makes trains, basically, in simple terms, but was very high-end locomotives. So there are many different types of companies that we discovered. What we did was, in terms of methodology, of course, we started off with these publicly available lists. There are there's one Indian firm, there is a US firm, consulting firm, which publishes these lists. But then we added on companies that have not sought capital, but that are unlisted and have a profit pool, which if you applied listed peer multiples. So suppose there's a consumer goods company. Now the consumer goods companies in the listed space, which if they had that profit pool, have $1 billion plus of valuation, so that we have included those. We've also included some companies which their last funding round was below $1 billion, but close to $1 billion. And since then, we talked to a very large number of VCs and private equity firms. We got a sense that since their last funding, they've actually grown a lot. So if they were to seek funding now, they will get $1 billion plus. So and some of them have actually closed funding rounds since we published the report. So we included that. We've also excluded. So there are firms which had $1 billion plus funding rounds, but since then have struggled. See, the one essential characteristic of startup ecosystem is that firms fail because they have very aggressive business plans. The PE firms, the VC firms reward them for growth. Sometimes they take on too much risk. Sometimes the innovation is found to be unviable. We have also excluded firms which are part of multinationals. So if you are an Indian subsidiary, like in consumer goods, in handsets, there are lots of Indian subs of multinationals which are clearly billion-dollar plus companies in terms of valuation. We've excluded those. We've also excluded the unlisted arms of conglomerates, right? So old-time conglomerates. Some of them have very high-end construction companies, for example, and we've excluded those. So we have a lot of exclusions from this list as well, and which is how we came to this. Now, despite the fact that we really threw the net wide, right? So there are companies which were founded, say, in 1965. Now, one of the reasons we included them is that recently they have shown very rapid growth. So you could have been founded, 50, 60, 70 years back, but you may have been stagnant, dormant. Maybe some new generation came in, maybe two families got together. And because of that, and because of all the changes we'll discuss, growth has taken off. So we've included those. But still, 2/3 of these companies started after 2005. Now, just for perspective, 180 companies in the BSE 500 are older than 1975. And only 63 companies in the BSE 500 have been founded this century. So this is really a reshaping of India's corporate landscape, right? So, and this kind of flies in the face of this fear that many have had that India is turning into an oligarchy and that a few business groups are becoming overly dominant. Actually, this is actually absolutely fascinating that there are new promoter groups, new entrepreneurs. Someone has made a lot of money in e-commerce, and now you must have seen has applied for a universal banking license, right? So even a vaccine company's promoter is investing in an NBFC. So there is a lot of and these are all pools of capital. These are all pools of risk capital. One of the important observations here is that we are not at the end of this process, right? We are at the beginning of this process, right? Maybe not right at the beginning, but very early stages of this process. Because the number of startups and the number of startups that are getting funded is 50, 60 times what on the list that we are talking about here. There is a natural weeding out. A lot of these startups will fail. That's the nature of startups. But so these are just the tallest companies, which in a forest which is fairly diverse and very fertile, right? And there is a new name called Soonicorns, right? I mean, I don't want to go down that and naming in a game, but there are many companies which are close to this $1 billion mark, and our expectation is that even in the next 3 to 5 years, as we sort of repeat these lists, I would not be surprised if we see multiples of what we have found this time. The geographical split, I'll skip because I want to finish this section in the next 30 minutes. See, to add a bit of meat to what Harish said earlier, that India, if your per capita wealth is $14,000, it is not unnatural that a large part of it will be in the in physical assets, right? So in the house people have, in the shop people own, gold jewelry and all of that. And if you think about saving patterns, initially as I can think about myself that, as I started saving, initially, of course, you have a little saving, then you start building your saving, then you get into fixed deposits, then you get into FMPs, bond funds, equity funds. It's only after, you lose a lot of hair and build a lot of gray hair that you start to reach a point where you can take some risk with your savings. Now, the one extreme example can be that, if you have, say, a steel company, right? So if you want to set up a new steel plant today, to make it viable, you need to have at least a 4,000 cubic meter furnace, right? Because you can do a 6,000 cubic meter furnace also, but that'll be an even bigger steel plant. Because if you do a smaller furnace than that, you're not viable. Now, a 4,000 cubic meter furnace means a 3 million tons per annum of steel capacity. That means $3 to $4 billion of greenfield capex. Even if you do 1:1 debt equity, you're talking about $1.5 to $2 billion of equity capital. which business group, how many business groups can afford that, right? And that's an extreme example. But similarly, getting $50-100 million of risk capital is actually a huge challenge for most people. So India has always had a problem with risk capital, and most countries do, right? So China had the same. The US, when it was an emerging market 200 years back, it had the same. So you generally at this stage of development rely on foreign savings, and also like what happened in China, what you do is you socialize the losses and you privatize the gains. So anyway, so India is not doing that. So we needed private equity. Now, private equity, you can see, has exceeded public market fundraising for most of the last 10 years. And this is a global phenomenon. A lot of this is because asset allocators globally, as the interest rates fell to close to zero, have switched not to equities, but to alternative assets. So private equity funds are getting a lot of funding. You can see that on the right-hand side chart that this is a global phenomenon. So a lot of, because there are companies 20 years back, 25 years back, which would list, some of the $1 trillion companies listed when they were a $1 billion company, right? But nowadays you have private firms listing for the first time when they are $100 billion, right? So there's a lot of private market activity that has picked up, and India is benefiting from that, though of course India's share of global private equity has actually picked up as well. But as I wrote in the second part of my 4-part series in the Business Standard, just funding will not make a business, right? So you need to have some business plan, and funding will allow you to take business risks. So now, instead of slowly building up your advertising and slowly building up your client base, these days companies start off with TV advertising, right? So so if you can get $100 million, you can speed up that process. Now you may end up blowing up that money, right? And then you will fail, and that's actually from a entrepreneurship perspective, and that is fine. But you need to have some plan of making money later on, right? So otherwise, no one can. You may question the intelligence of many Ps and VCs. I don't think you should, but even if you do, as to who's giving them this money at this valuation. But the point is, even they are seeing some profit at the end of the tunnel, right? I mean, they're not just just throwing away money after whims and fancies. So one of the most important changes has been the improvement in teledensity, right? So we have now 85% of the people have phones, which is still low. I mean, I think it should be the actual teledensity on SIM cards is much higher, but the percentage of people with phones is actually smaller because there are many dual SIM phones and all that. There are 38% of the people have smartphones. Smartphones are computing, right? So you can do a lot of user end computing now. So you can have encryption at the user end. You can therefore manage money at the user end. You can get the phone to do a lot of processing for location. A lot of other things can happen once you have a smartphone. And this 38%, it is expected will be 85-90% in the next 4 or 5 years. So I think this is a very important change that has happened. And of course, this is built on the base of rural roads. These are very simple things, but the sad reality is that till the year 2000, and you can see the left-hand side chart, how the road construction has picked up after that. Everyone tracks national highways. No one tracks rural roads. Well, I do, but very few people do. And the reality is that if half of your habitations are not connected by all-weather roads, then, and Harish would know better than any of us, then how do you evacuate dairy? How do you evacuate fruits and vegetables? How do you evacuate labor, right? If you're sitting in a village where it takes 3 hours to get out of the village, how do you even go out and find work? So I think this is very important. Roads enable electricity. I remember in my village in Champaran, we had electricity poles set up at least twice. So I think once in the 1960s and then maybe in the 1980s. After waiting for 10-12 years, people sort of broke them down and started using them as plows, right? So because if your transformer breaks down, how does the engineer come and repair it? If your transmission line is 60 kilometers and it breaks down because some accident or some flood or something, how do you go even and check where the line is broken down, right? So without roads, even maintaining basic infrastructure is a nightmare. So roads has been very important. That has allowed for electrification to happen. Of course, electrification has been a different project. And on the back of electrification and phones, has come the universal bank account access, right? So you see, if you per transaction in a bank branch, the cost is 70 rupees. This was done several years back. Maybe it is now 100 rupees. In an ATM, it could be 20-25 rupees. On a phone, mobile banking, it could be 1 rupee or 70 paise or 50 paise. And unless you got that, I mean, you could do all the nationalization. The rural bank account penetration would never happen. So it was because phones came, because Aadhaar came, the KYC cost dropped to near zero, that you could get everyone to have a bank account. And that's when the Jam Trinity came, right? And Jam Trinity, we all got excited 6-7 years back. Now layers are being built on top of that. So what we see now is UPI, right? UPI, now 30% by value of payments in India is now digital. And this again is a platform, right? So this creates another layer. That's why I called the second part of my 4-part series as progress comes in layers. So you build your roads, then you get electricity, then you get phones, then you get bank accounts, then you get payment systems, you get a lot of data. And then on top of that, you start building lending, right? So once the data accumulates, the lending models have sort of become more mature. You start off with, so the first thing is that some of these fintech companies have done is that they have made people used to transacting with money on their phones. This is we all now take it for granted, but this is a huge behavioral change, right? That you make payments to the vendor, you make person-to-person transfers to the school teacher, to some friend, so this behavioral change, and you can see that even the smallest of these companies, well, not the smallest, but the smallest in this list, you can see 75 million users. The largest Indian bank has 55 million users. So we are talking about improvement of financial penetration by sheer numbers of a very different order of magnitude. And so as this happens, now the digital lending can start to take off. Now we have the account aggregator model coming up, and it is no longer a pipe dream, right? So we've been thinking about this, hearing about this in very small ways, contributing to this over the last 6-7 years, but it is now becoming mature. Now it is likely that some of these, what seem to be pipe dreams, may be becoming real. So this is creating businesses, unicorns in the fintech ecosystem, but they're also enabling other businesses. So because if credit is provided in what is a parched ecosystem where informal firms struggle for loans, this is something that can enable other businesses to grow as well. In EdTech, and this is again a chart which, if I had to make today, I would do it differently. So this is all the domestic ecosystem. So you can see that, and there are more interesting charts in the report as well, that of course the domestic EdTech market is exploding, right? So there is a very rapid growth in this. Of course, the pandemic has accelerated this trend, but the pandemic has accelerated another trend which I don't think is that well appreciated, which is the export market. So from standstill, EdTech companies have gone from zero revenues in 2019 to one of them 70 million, another $100 million in the US last year. To the extent that I've heard VCs asking a question, who in 1995 would have thought that India would make software for the whole world? And that's a valid question, because I worked in Infosys, from 2000 to 2003, it was just after the Y2K thing and just after the dot-com bubble burst. And I've seen firsthand how offshoring really took off. And so all of those things are now possible in education, right? Where you are setting up the company does not matter, because the content creation can happen in India. So this is again very early stages of innovation in EdTech. I'm not saying that the content is very high end right now, but I do think that newer and newer layers of better solutions will be built, and India has a great opportunity there. Same in software as a service. So see, the software as a service ecosystem is actually quite fascinating. See, first you have 45 lakh trained engineers. And you can question what was the quality of the people graduating from Indian engineering colleges. But the point is that, they join the leading IT firms, they get thok bajao, they finally in 6 months, they are all trained, 12 months, they are all trained, and they all have good experience of writing cutting edge software. Now, what has started to happen post the cloud, right? So in software development also, the earlier requirement, say when I was a software architect, so we have been used to making, cross application calls, like, work with, say, I don't know if you've heard of the term, but Corba, etc. We have existed for 20, 25 years. And applications calling each other has been a norm, for much longer. The interesting thing now is that companies are getting used to not having in-premise software and hardware. So the server farm does not need to reside on your office premises, and the software is not licensed that you pay for, once, right? So you're using it, and you're used to paying for software on a per use basis now, and you can call applications across firms, so therefore the software that is getting built can be built in small parcels. So you can create small solutions. You don't need to be installing it everywhere. So the nature of software development, the nature of software sales has all changed. And so in India, that's allowed a lot of young engineers. If you see the backstory of many of these startups, they've the early ones just stumbled into it. I mean, they didn't know what they were creating was very valuable. They just found that they posted the software somewhere. Someone said, oh, can you just modify it for me? They would do it once or twice. Then more requests started coming. I said, boss, free ka kitna karega? So how long can I keep, writing free software? No, we'll pay you for that. And that's how these businesses have evolved. And there are interesting backstories. Now, what has happened now is that, back in 2004-05, if you had a very entrepreneurial engineer, he would say, I will build the next Infosys. But now everyone is saying, oh no, I will build the next SaaS company. So the number of SaaS companies getting funding is of course has grown 4x in the last 5 years. And SaaS is an ecosystem, is a type of company where firms don't need funding. If you ask many of the VCs, the toughest part of investing in SaaS is that they don't need the cash, because they are heavily cash generative, right? So in a typical IT service company, the cost per engineer is about 10 lakhs. I mean, I'm just giving hypothetical numbers, and you'll hope to get 25 lakhs of revenue from that. 5 lakh is your profit, 10 lakh is your cost of underutilization, training, sales, infrastructure, giving them a computer and all that. But in a SaaS company, though of course that's not the revenue model, but on average you could be generating 1 crore of revenues. So these are incredibly profitable companies and generating massive amounts of cash. So they don't need any extra funding. So VCs, why will they go to VCs, right? So this is just the number of companies that are getting funding. The reality is that the actual number of companies is much larger. And you are seeing earlier and earlier stage. So some friends of mine, they started a company, which of course they're extremely rich, but so it's now listed and stuff. But they started in the Bay Area in 2009, set up an India Development Center in 2013. One of them decided to branch off and do something on his own, right? And within the first year, he set up a India Development Center. The one who stuck around was the CEO till last year. He resigned and he started his own, the next startup. On day one, he has an India Development Center. So the engineers who are joining these firms are now realizing that they can write cutting edge software, and that the firms that the software we built can go into, so imagine the ambition level, the training that some of these guys are getting. And therefore, I think this is a very fertile ecosystem. I won't be surprised if the number of unicorns, goes from 11 to say 30 or 40 in the next 3 years. E-commerce, we all know. All I want to say here is that e-commerce is an enabler as much as it is a wealth creator by itself. For example, if you were earlier, you had a great product idea, you had a great brand idea, you would still need to distribute. You will need to, go and sign on thousands of distributors who will then reach out to millions of retailers. But now you can just deal with a few specialized distributors, a few e-commerce firms and modern trade, and you can reach a fairly large part of the population. In terms of brand building, you don't necessarily have to go on TV, right? You can actually target much lower income segments through phones, through the internet, and at a much lower cost per impression. So the cost of brand building, the cost of product innovation, the early stage penetration is all being enabled. So this is again specialization, right? Earlier, you couldn't specialize. You had to be great at distribution. You had to be great at TV advertising. You had to build a national footprint before you could advertise. That itself was an entry barrier. Now all of those barriers are gone. So there are lots of new fascinating product ideas, fascinating brands which are getting developed, which are still in the 300, 500 million range. So very few of them are part of our unicorn list. But I won't be surprised if in 3 to 5 years you see a very large number of them either getting listed or joining this gap. In pharma and biotech as well, when I used to be a pharma analyst, these $1 billion of sales used to be a dream. Now, if someone said that X company targets $1 billion of sales in the next 5 years, you will say, ha ha ha, right? And now many of these companies are doing $3 to $5 billion of sales. 80% of the business is exports. What has happened as a result is that their R&D budgets are now scaling up. So from if you're doing 8 to 9% of revenue as R&D, you suddenly have $250, $300 million of R&D. Now you can do specialty drugs. I mean, you don't necessarily have to be copycat. So if you have $30, $40 million of R&D budget, there's only so much capex you can do. So that and Harish, in the book that you're writing, just like as you grow scale, you go from doing the 50 crore project to the 500 crore projects. But it took the company on which you're writing the book, it took them 30 years to do that. Some of these companies have also spent 30 years doing that, but now they're at a level. So just like the ambition 20 years back for an enterprising pharma entrepreneur was to do, I will do 200 ANDAs. ANDAs are the generic drug filings. Now the entrepreneurs are saying, oh, I'll do this specialty drug, I'll do this delayed release, I will do this a small clinical trial so that I can get 5 years of patent protection. So the ambitions are changing, and that the ecosystem is now moving to the next level. So which is very fascinating. Last bit, and then I will stop. See, the number of companies in India was growing in double digits, even in the 1980s, right? So this was not the peak. I think 70s was the peak, but even in the 80s, there were lots of restrictions, controller of capital accounts, lots of controls on companies. But still, the number of private companies was growing in the low teens every year, CAGR, right? Cumulative annual growth rate. And the problem was that they didn't have capital, right? So the paid-up capital, which is a very weak proxy, but that's the best comprehensive data set we have. The paid-up capital, and you'll see that in the report that's not there here, that it was flat for 12 years, despite high inflation. It is only after the controller of capital account went away, post-1991, that some of these companies really started to invest. But early on, as you were saying, this was all business groups. So business groups who had already accumulated pools of capital, so they diversified. So an auto company, because the business, the family was growing, got into financial services, got into insurance, got into sugar production, got into almond oil production, and all of that. But many of these, and which is why in many ways this unicorn list that we have is first generation entrepreneurs. So we have to measure the quality of this, or the number of these first generation entrepreneurs, we have not included many of the $1 billion plus unlisted companies which belong to business groups, because their risk capital availability was much easier. What is fascinating about this list is that and they are all first generation, and they're growing on the back of venture capital and private equity. What this is doing is creating a very fertile and a very virtuous cycle and a very fertile ecosystem where the wealth, I was talking today to someone who said that, many of these, forget about planning for, the next generation. Do I have 5 kids or 3 kids and I need to create a business for each of them? Many of them are unmarried, right? So their thinking is more of, if I have risk capital, what do I do? And so they're all, they have a lot of savings, I've created a lot of wealth. They're redeploying it in new startups. So some of the people, the business, the entrepreneurs who created a lot of wealth for themselves and for their investors are now reinvesting that in new startups. So some of them have portfolios going to 40 to 60 companies, and so this is so if the number of millionaires just shoots up, right? So when some of these companies list, you will find a very large number of millionaires emerging in India. And as that list becomes larger, the availability of risk capital is going to be, at least addressed, and therefore that creates a virtuous cycle. Many of the businesses that are getting funding are really aggressive in their business models, which I think is again good for rapid growth. They will destroy a lot of wealth. That's the nature of the business. But overall, statistically, I think this is great for the economy. Some of the PE funds, so for the largest fund that you can think of, they made some money in one IPO, invested it in a Chinese firm. The Chinese firm's IPO created a lot of wealth for them, and then they came back and invested a lot in Indian firms. That has generated good returns. So all of that money is now getting recycled, right? So now you're seeing some of these funds active in so it's not just the wealth from these entrepreneurs and the employees they have. Also, the PE funds which are making good returns are very likely to invest here. In terms of economic salience, so the incremental sales for this set that we have, would be about 5% of incremental GDP in the next 4 to 5 years, which makes them quite salient and relevant. And this is just the first order impact, right? So in terms of the value add that they are generating. But they are also enabling, as I said, if you have a fintech unicorn which is doing digital lending, there are lots of businesses which are growing because now they are starting to get credit. Or if there's an e-commerce company growing, so they are also enabling, right? So there are some on the supply side, there are many small businesses which are now joining the e-commerce bandwagon and developing. So this is, I think, very much a virtuous cycle in my view, and therefore we are in the early stages of discovering these unicorns. So on that note, I'll stop and hand over to Rohit and Harish for questions.
Thanks so much, Neelkanth. This is fantastic, and I don't claim to understand a lot of what you're talking about. Just for people who just joined, Harish and I are going to ask questions for about 20 minutes, and then you can also put your questions in the Q&A box in Zoom, and in the last half an hour, we'll try to ask audience questions as well. So please do stick around for the audience Q&A if that interests you. Neelkanth, I guess I'd like you to zoom out a little bit, right? So this 100 unicorns is kind of a significant, small but growing part of the Indian economy. It's very exciting. It has all of these things. But obviously, I mean, Credit Suisse has done a lot of work on kind of the bigger macro picture, including all of the house of debt work and these kinds of things. And I'd like you to tell me a little bit about public sector bank credit versus BCP money as complements versus substitutes of some kind, right? So in some sense, one argument is that like these are completely different markets, right? The public sector banks serve the old economy, infrastructure, industrials, big business groups, all of these kinds of things. This money is targeting a very different crowd, and so there's clearly no overlap. But there's some interesting, like this rise has happened in the middle of all of this NPA crisis as well, right? So it's not completely unconnected in some sense. The capital shortage is real, and the BCP money comes in light of all of these things. Is there a relationship between these two processes at all? And what do you think about them? I'd love to hear that.
So they are only very vaguely connected. The house of debt was, 7 out of those 10 have collapsed, right? So house of debt was mostly about firms which through unfair means had become too large for the banking system and created pyramids of excess debt, which then sort of imploded at the slightest risk. Now, so this is more about business momentum. As I said, software as a service, healthcare, the penetration of smartphones. So these are very different businesses and very different dynamics. The common thread, if I have to look for one, is that in many ways the PSU banks were a channel for the China model of socialize losses and privatize debt, privatize gains. Meaning that, so there are entrepreneurs and very large business owners who have told me in private that, look, if the PSU banks had not given me money, how would I have scaled up? See, if you're starting with very low risk capital, how do you grow fast, right? Because if your risk capital is accumulating at 15-20%, then the next year you can only do 15-20% higher investment. If you want to do 5x, 10x larger investments, how do you really grow that fast? And if you do that and you take on a lot of debt, if something adverse happens, so if you're making business with big investments in steel and the steel cycle turns, you go bankrupt. And when you go bankrupt, not only does your equity capital get wiped out because there was too little of it anyway, the bank also has to bear those losses, right? Now, this has happened almost at a systemic level in China, right? That you give the depositors 2% interest, the banks lend at 6%, 5% or whatever, and so there is adequate buffer to absorb losses. The businesses that work, they become billionaires, and they've created many more billionaires than us. And if the losses happen, the banks absorb it, right? And if even that buffer is not enough, then once in 10-15 years, the government gives them some capital. So, but that's a model that we chose not to follow, and I don't think is in many ways is a fair model to follow, right? And we can discuss and debate. But so the availability of risk capital is allowing businesses to grow without taking those kind of risks, right? That where you put the savings of others, and so in many ways it's a fairer thing. I don't know. I mean, it's a much bigger debate on whether it is good for the country or bad for the country, right? That the fact that many of these businesses after Series C funding go and register themselves abroad because the bulk of their shareholding is foreign capital, and those foreign investors are afraid of retrospective tax changes or whatever, and therefore are recommending that their investee companies register themselves abroad. So there are pros and cons, but if anything, that is the only link I see that that socialized losses, privatized gains model is no longer functional, and so this availability of risk capital is providing an avenue for growth.
Neelkanth, see, just to, I'm just trying to get what you're trying to say. See, if we look at the first flush of enterprise, post 91, it was basically a result of many government reserved sectors being thrown open for private investment, right? I mean, telecom, aviation, banking, ports, power, highways, even something like dairy, So in the case of these unicorns, I mean, is it that the drivers are whatever, formalization, IT, mobile-enabled penetration, and COVID? I don't know. What is the thing? I mean, how is it coming? What is liberalization to?
Totally. So I think that you see the first round of businesses came up in segments where the government monopoly was dismantled, right? So there were some 18 sectors where the government had monopoly till 91, and that included metal production, banking, airlines, telecom. And so if you see the growth in Indian businesses, so over and above the consumer goods, which are always happening anyway, the big businesses have come up in steel, in aluminium, in telecom. There are some decent airline businesses. So petrochemicals, so these ports. So these are all the big, or even the power sector, right? So after 2003, the Electricity Act, the power sector became a lot more active. So I think these businesses are, in some cases, tackling the export market. So like the Saas companies are all about exports, right? So the business software industry in India itself is too small. And so necessarily you're exporting your stuff. And I think that will continue to happen for the foreseeable future. The pharma companies, 80% is all exports of their revenues. and if they have to grow further, there is a decent pace of growth in the Indian market, but I think the size of incremental revenue you can get abroad is much bigger. But yeah, and I think all the others are, I think, taking advantage of the changes in technology, and therefore this is not just sort of stepping into areas where the government has now allowed you to function, but actually creating new areas, new types of business models. So there is these are also actually, if you see the sectors they're in, they are in a whole range. And in fact, what you may see is that say in renewable energy or in the setup of renewable energy, you may even see companies in data centers. You may see even in industrials, new types. So one of the things we excluded, so it's people debate why we did that, is construction companies are out of this list deliberately, right? So because for us it was very hard to figure out whether that risk capital was coming from the promoter and built over 20 years, 30 years, or was it parked money for some politician? So it's not very easy to find out, and because access is a very important role in construction, so we excluded that. But say clean energy or water or sewerage management or urban transport, as these monopolies, power distribution, as these monopolies get dismantled, whenever these monopolies get dismantled, I think it'll throw up new opportunities. And given the new ecosystem where private equity is very active, the number of private equity firms keeps growing. There is a much more diverse set of individuals or investors. Everything from pure debt to distressed debt to structured debt to the angel investor groups that are emerging in every city, to firms that specialize in the Series A, Series B, Series B, Series C, Series D, and then the big deal guys, who can actually take on a $5-10 billion company as well. So as this ecosystem matures, I think if new businesses or business opportunities open up, it will be possible for completely new business groups to take on those businesses. So there is a lot of potential that can emerge later on as well.
Okay, yeah.
Yeah, so I think you mentioned a few interesting things, right? So even if you take the one energy company in yours, right? I mean, it's a company that basically imports panels and deploys them and understands the Indian market in some senses. And there's this interesting question of if you look at the distribution of your unicorns, very few of them are fit into India's manufacturing dream of sorts, right? I mean, they're not make in India companies for the most part. There's a few exceptions. And so, I mean, in some sense, first of all, is this a reasonable expectation, right? I mean, the kind of capital that are coming into these kinds of companies, will they ever finance heavy manufacturing in any kind of serious way? I mean, I guess I'd like you to tease out a little bit, is there a connection between this unicorn story and a larger kind of domestic manufacturing scene, or is that just an unrealistic expectation?
Yeah, so let's think about the current ecosystem, right? So if you think about construction equipment, for example, and we think that private sector capex will pick up because of production linked incentive schemes, etc., in the next 5 years, and I think the economy is going to grow reasonably well. So there will be capex, but when you start looking for companies that can take advantage of this, you are left with the Indian subsidiaries of multinationals, right? So Japanese, Korean, European companies, and so they own all the technology. If you think about hardware tech, right? So in software, for example, the high-end phones that are getting manufactured, and I think that ecosystem is really doing very well. So it's actually in the PLI schemes. So even the non-PLI beneficiaries are actually setting up shop in India. So I don't know if you have thought about this, but see, the global smartphone market is about 1.65 billion units, 1.6 to 1.7 billion units. And India's target through the PLI schemes is to do 1 billion phones in the next 5 years, right? And we did about 320 million, the year before in FY20. So, so the question to ask is, how can, and this was my incredulous question to people in the industry, how can we do 1 billion phones? I mean, will the Chinese start manufacturing in India? And people in the industry said yes. And he said, well, how can that happen? But guess what? Now, even the non-PLI setup, there are a lot of firms that are now expanding in India. So suddenly that 1 billion unit doesn't look, I mean, it may not still happen. I mean, it'll definitely be more than the 600 million that we have been projecting in 5 years. But it is remarkable how rapidly that ecosystem of cell phone assembly is getting established in India. Now, what this will do, and so there are some, I wish I could show you some of those. Maybe I can, I'll stop sharing this. I'll open another presentation which has some of that data, and I'll show that to you. So what is quite remarkable in this sector is that the let me just open that realizing how. See, India, even in 2012-13, when the feature phone market was the dominant one, was still doing, at one point, including, of course, Nokia, but there was lots of Indian brands which were, exporting to Sub-Saharan Africa, to West Asia. And so they have the ability to build the brands. And some of them are actually quite excited that if the ecosystem starts to come to India in a big way, right? Why can't we, so I'll show you, let me project this. So you can see the right-hand side chart and look at the gray bars, right? The dark gray bars, actually both bars are gray. So the dark gray bars, that is India's exports of phones. So as the market shifted away from feature phones to smartphones, these Indian guys lost out, right? And so these are brands that at one point used to advertise, sponsor the Indian cricket team and all that. Now, the point is that many of these are back in the game. So they are saying that if all the global smartphone majors start manufacturing in India, then we can use that ecosystem, because then suddenly the casing company, the battery company, the display device driver company, all of them start happening, and a lot of design ecosystems shift to India. Why can't we develop our own brands in the export markets? Why can't we dominate the sub $150 smartphone globally? And the truth is that 10 years back, the Chinese smartphone brands were non-existent, right? It was mostly Korean and Japanese and European names and American names. So I think this can very quickly shift. And if these companies show promise, if it comes to capex, I think private equity firms will give them the money. The bigger question is, will there be upstream investment, right? So the value add, right? Because in smartphones, assembly is like 3 to 5% in the high-end phones and maybe 7-8% in the low-end phones. So will we have a component ecosystem shifting? They are actually starting to shift. So there are casings companies, there are battery companies, camera module assembly. So step by step. But this is a 10-15 year process. Once we have that ecosystem, then Indian entrepreneurs come in. See, right now there is no, it's like, expecting that, there will be SaaS companies and product companies developing, back in 95. There were companies like Zoho, which 97, 98 started, writing the first software, but he then, reinvested, and now he has reached a scale where he can, as he says that, he can invest for a product which will deliver revenues in 5 years. But at that time, he said I had to write software which had to deliver revenues in 1 year. Otherwise, I couldn't survive. Now, in the hardware tech ecosystem, I think that it is over a period of time. So as the ecosystem, there are design engineers. You'll see a very nice documentary in Super Factories on National Geographic. I think it's there on Hotstar. That there are design offices, cell phone design offices, which are now sprouting up in India. Now, think about the folks who are working there. If there is an entrepreneurial guy, he can say, boss, this is not very complex, right? I can do this on my own. So there is this company called Luxshare in China. So as Apple decided to split its China and ex-China ecosystems from the manufacturing perspective, so their Apple assembly unit in China was sold to Luxshare. The interesting thing about Luxshare as a company is that their founder used to work in a Honhai factory in 2003, in the early 2000s, and then she started this company in 2003 or something, right? So it is only when you have a certain number of people who are familiar with the supply chains, who are aware of what the technology drivers are, that the skill set develops. There is a large enough set of people, and then one of them becomes entrepreneurial, or a few of them become entrepreneurial and start the new company. It's the same like in the auto ecosystem, right? We have a very vibrant auto component ecosystem. If the PLI schemes in autos really take off, right? I mean, I think it's taking a lot longer than was earlier thought to launch those schemes. But if they are able to really get the champion OEMs and the component guys then become larger, I won't be surprised if some of them actually start becoming world beaters. So it's a slow grind. See, in IT, it has taken us 25 years, 30 years to reach this point, right? In software, in chip design, we are already there. But in manufacturing, it will take 10, 15 years to get there. But the process has started. So I'm still hopeful, but I wouldn't expect a unicorn coming up in the next 5 years in manufacturing.
Actually, the phenomenon which you are describing is, you ask me, it's quite bizarre, I mean, because on the one hand, I mean, as Rohit was mentioning, you have banks with NPAs, etc. Okay, and even when you look at these 100 unicorns, see, how does one reconcile their rise with the fall of many corporates, in recent times? And when I'm saying about these big corporates, I'm not talking of old guys. I'm talking of many of these who were actually, I mean, they represent real trailblazing success stories from the 1991 reforms. I mean, look at Z Telefilms, Jet Airways, Big Bazaar, Lanco, GVK, JP, Moserbear, Mr. Rana Kapoor, so many of them. I mean, how is this? I mean, this seems to be a parallel phenomenon. On the one hand, banks unable to lend, whereas the PE guys lending like anything. I mean, so if you look at it as a twin balance sheet kind of a thing, it seems to be that we are in two different worlds, right? I mean, on the one hand, there is a lot of lending, a lot of entrepreneurs. On the other side, you have a twin balance sheet problem, right? I mean, how are these two? I mean, are these
no, so I think you're right. They're totally other than in the conceptual risk capital development and corruption, etc. There may be some link, but that socialization of losses and privatization of gains perspective, there is some link perhaps, but otherwise they are very different ecosystems. See, the first list that you talked of, if you classify them into 2 or 3 buckets. The first bucket is exactly the problem that we discussed earlier, that you want to grow fast, you take on a lot of debt because you don't have risk capital, and then those pyramid structures start getting created. So you take debt at the parent level, make it equity at a subsidiary level, and then on that equity you take on more debt. So it looks like every company has only 1:1 debt equity, but at a group level you are actually 5:1, 6:1 debt equity. So even a minor economic shock and the whole house of cards collapses. So that is the first bucket, right? So where you have over leveraged yourself and you see a cycle going wrong, like in steel, right? So as people say, right, that if the steel cycle had, if today's steel profitability was seen 7-8 years back, then many of these firms would not have gone under, right? Despite the fact that some of them were clearly siphoning out money and all that, but the point is that they would still have survived. the second bucket are out and out access companies, right? So companies that that only survived because they had access to capital, they had access to politicians, and so as some of those sort of networks got shaken up, and perhaps they upset some people, so they just fell out, right? And so I would say that if you and beyond that, I can't think of, if I go through the list that you just mentioned. So there are, and then there are companies in segments where the industry itself just got wiped out, right? That the technology transition took the business away from you. So and that is bound to happen. See, even in the S&P 500, even in the FTSE, right? The UK stock exchange, the index, the list of companies keeps changing, right? So there will be companies, business groups which make bad business decisions, lose interest in the business, either sell out or just drive the industry into the ground, or drive the company into the ground, and new companies take their place. It's just that in India's case, I would say that era, or that bunch of companies has shrunk in importance. I think a lot of that cleanup happened between 2012 and 16, 17. And once that is done, I think the bank balance sheets are much cleaner. There may be a few business groups because of sectoral competition, say in telecom, where some people think there is a lot of risk, but otherwise, by and large, we have kind of cleaned that up. And this is a very parallel ecosystem. I mean, you'll see that one of the characteristics of startups is that they rarely take debt, right? Because if you are dealing with a very uncertain business environment, the last thing you want is debt.
Right.
So Harish, why don't we go to some of the audience questions and we can come back to us. So Why don't you go ahead and ask Partho's question?
Oh, I think there's an audience question, right? I mean.
Oh, actually, yeah. So Partho sent me a question. Let me ask that one first. So I guess one thing about startup and unicorn employment is that it is certainly very kind of elite and high end among a particular kind of educated, technically savvy kind of person, right? I mean, what does the job chain look like? I mean, are these companies going to come to the point where they're employing the class 10 non-English pass out in North India at some point? Or, is the nature of their employment and the nature of their work always going to be that way, right? And in some senses, the unicorn ecosystem is not nearly like a fortune at the bottom of the pyramid type of ecosystem, right? Do you think that can change, or is that not the nature of the beast?
See, so if you go through this list, so there are clearly high skill exporters, right? So say in Saas, in healthcare, and to a large extent, even in things like fintech, right? So they're not exporters really, but very few people, writing algorithms or just running servers much better than others can actually grow their business. But at the same time, if you think about a food delivery company, if you think about or many of the e-commerce companies, right? So the e-commerce companies, while we think about the jobs for the delivery boys, but think about on the supply side, right? Because by law, many of these are actually marketplaces. They are not necessarily just companies that own inventory, and so you must be seeing those claims that one of the largest e-commerce companies, of course, a multinational, is now exporting $2 billion from India from very small suppliers, right? So all the niche suppliers, say some Tat Sari in West Bengal, or some makhana manufacturer in Bihar, or something like that. I mean, so earlier accessing this market was a nightmare, and because these pipes are being created for movement of goods and for movement of funds, many of those are, I think, getting enabled as well. Same with edutech, right? So while there is some centralization of content creation, etc., the opportunity is see, if you I mean, I don't want to go to that extreme, but the teaching of US students, why can't it happen from India, right? And it's right now seems impossible, and it will just be that some app helps them prepare for exam prep app or something. But over a period of time, if teachers in India are getting 12 to 15,000 rupees, which is, I think, a shame, really. I mean, I think doctors and teachers, I think that those two segments where I think we treat them, I mean, they're the most important people in the economy and we treat them the worst. So why can't this, and this I think is going to happen. I mean, that's a rhetorical question. I think this is going to happen. So I think that while many of these jobs are in the software development ecosystem, many of them are in the high tech and financing and all of that. But the businesses they support, or look at shared mobility companies, right? So the fact that so many drivers got jobs because earlier, unless you were in Mumbai and there was a Kalipili, and Delhi had never had any taxis. Right? I mean, you land up at an airport and you're wondering how to get to your office. And in the tier 2 towns, it was impossible to get any taxi because. But these are all have been created, and these have created 100,000, 200,000 jobs. So I think that as innovation happens, see, eventually it is about reducing cost per transaction, right? So each of these is just bringing down cost. Like look at entertainment, right? So if you think about leisure 200 years back was only possible, like entertainment or by musicians or dramatists, was you needed to have a patron, right? It had to be a king or some rich individual. It was only when reproduction became cheap that you record a video and a lot of people can pay 500 rupees or 100 rupees or 50 rupees, and so that's when it got truly democratized. So I think technology will create those opportunities for a very large number of people. I think that's bound to happen.
No, thanks. Kandala Subramaniam has two related questions. I think one was on the sustainability of this startup culture, right? I mean, entrepreneurship is kind of an instinct in how do you create enough hubs for these kinds of things? I mean, is this a passing fad or is this something which will continue? I think that's one part of his question. And then another part of it is, what can government do, for example, to design, legislation or policy in the Income Tax Act or usage of CSR funds or many other things to make things easier for startups, right? I mean, there's a lot of the Startup India conversation happening now. Every state wants to start a startup competition and all of these kinds of things. Some are better at it than others. Are there some very clear enablers on this front which can reduce some of those frictions, increase some of these scaling opportunities, all of those kinds of things?
Yeah, so I think both are great questions. I'll just finish. So add one more point here. See, the ease of payments or the availability of some of these apps also enables, say travel and tourism. As of now, in the middle of the pandemic, looks very hard. But I think in 3-4 months' time, that's my hope, we will be out of it. And so think about. I 2 years back, I was able to, sitting in Mumbai, create a travel plan for my parents for South India's temple tour, right? And I could book the hotels, and none of these were like the 5-star hotels, right? We're going to small temple towns, 2-star, 3-star hotels, clean stuff, functional stuff, and talk to a taxi driver. And pay him online, and he was willing to accept it, right? So all of this is it is enabling. I mean, if these tools had not existed, you would not have had those 2-star, 3-star hotels those taxi drivers getting jobs and income. So I think there are big enablers, and I think there's a lot of opportunity. Now, is entrepreneurship, this is a passing fad? Absolutely not. I think, what is now starting to happen? See, the first thing we have to remember is that we are an entrepreneurial society, right? Even in the 1980s, people were starting companies. So there will always be people who will, and it may not be just from the traditional business communities, right? I mean, the caste-based filter that Harish loves to apply. I think it can be, it can be any community because there is an opportunity, and therefore, I think this will happen. What will happen though, that there will be cycles of valuation. So right now we are going through a euphoric phase, right? So there's no end to valuation. So what I see what I see happening, if you see my hand, is like higher up and higher down. So higher lows and higher ups and higher lows. So it's an upward sloping curve, but you're seeing volatility around that. If you go back and see what happened in the US in the early 19th century, the same cycle was playing out through debt. So they were also dependent on foreign capital. They were not very different from Latin America at that time, or say Brazil, Argentina. They were all emerging markets. There was a lot of savings that were flowing from England, from Netherlands, from Belgium, and it was all in the form of debt because cross-border equity was much harder then. There were no private equity firms, I guess. And there were state governments in the US which used to default. So in fact, there's a very famous anecdote of some explorer who raised money for a country that didn't exist. So there were scams, there were crises, there were busts, and every 7 to 10 years there would be a bust, and then the same thing would start again because the opportunity was there, because there was a lot of land, there were a lot of people moving there, economy was growing. If the economy keeps growing, which I think it will, then I think capital will keep coming in, and because look at the example that is being created, right? Every 28 to 30-year-old is today thinking, what am I doing earning a salary, right? Now, this will also go in waves. So there will be people who will burn their hands because we only hear of the success stories. There are thousands of startups that fail. So this will go in cycles, but I don't think this is the end of entrepreneurship. Can the government make it easy? Of course, I think the difficulty in registering a company, while it is much easier than it was 20 years back, it is still not very easy. Last mile tax compliance, so I've heard of stories of and this is real story, I'm not cooking it up, that there's this guy who gets the GST inspector, and the GST inspector sits in his office and says, get me that data. So he gets him the data. Then he says, get me that data. So he gets him the data. So after 2 days, he says, देखिए, मैं मांगता रहूंगा, आप देते रहेंगे, थोड़ा पैसे की बात हो जाए तो तुरंत समझ जाएगा, right? So now the point is that so at the last mile, I think the state can still be a big deterrent in doing this, and closing businesses is a nightmare, right? So you have to make exit easier for more entry to happen, and I think there are many things. So I agree that the startup ecosystem, and which is actually something that perhaps governments can do, though ideally it's it would seem to be an oxymoron that you want entrepreneurship to be supported by the government, but I was shocked. A friend of mine who I think runs a fairly diversified business and doing extremely well. So he wanted to list one of his businesses because he wanted to raise 40 crores of capital. This was 3 years back. So I said, well, no, why aren't you taking private equity? So he says, what is private equity? And this is a guy who went to IIT with me, right? So I was wondering what the PE firms are doing, but the reality is that, because they should have reached out to this guy, because he's not just because he's a friend, that clean business, clean accounts, very savvy promoters, and doing extraordinarily well. And this guy was wanting to list. Like, boss, 40 crores ke liye list kyun karta hai? So why you can get private equity. So I think the awareness of the opportunities. So as Harish was saying, that there is a company from Trivandrum or Thiruvananthapuram. When I did this geographical mix of companies, right? The reason why I even had this chart was that I thought it would be a lot more diverse. Right, it is already quite diverse. I mean, it's not just the Mumbai, Delhi kind of split, but Bangalore kind of split. But I had thought that there would be a lot more companies from Jaipur, a lot more from. Well, I think Ranchi is a.
Yeah,
that is one. But say Calcutta, Bhubaneswar. So I expected that there would be a lot more of companies there because, there are IT engineers, there are very entrepreneurial people, and but that's not happened yet. And so maybe the awareness of opportunities and just the belief that you don't need to just be in Bangalore to get funding and capital, and that you can create these ecosystems. And it won't be a 6-month process; it'll be a 5-year process. I was pleasantly surprised that there is the venture cell, the incubation cell at IIT Kanpur, actually on the ventilator project. The very fact that they were working on automating, cleaning of solar panels, and they switched to making ventilators last year. The fact that they were there, and that so it takes time, right? So you start those incubation cells, and then people, and then an ecosystem emerges. You see 1 or 2 successes. And then it kind of snowballs. So there is the role that state governments can play, but I think so far the fact that it has grown reasonably well without much of direct government intervention, it is better to keep it that way.
Neelkanth, one question which I wanted to ask was, how many of these unicorns are kind of built to last businesses? Many of these promoters seem to have, either sold out or exited pretty early. I mean, the Flipkart, and more recently, I think even something like Big Basket, right? I mean, so what is the thing? I mean, even before they turn profitable, if you were to tell these kind of things to traditional entrepreneurs, I mean, many of them are scandalized. I mean, how I mean, they don't seem to be whatever. I mean, many of the entrepreneurs I know, I mean, they identify so much with their business. They don't. For them, it's nothing. I mean, the business is they themselves. It's whatever, good or bad. I mean, but here it seems to be a very different kind of a thing, right? I mean, what is the reason?
The reason is very simple. So if you look at the global tech ecosystem, so some of the global tech behemoths in the US, for example, are very, very active in acquisitions. And a very common exit strategy is for VCs and for new businesses is to sell off to a big firm. Because see, the reality is that as the firm grows bigger, it becomes more bureaucratic. Right, so it is very hard to take decisions on the fly. I mean, the wealth creation attracts a lot of people, but you go through the history of so the narrative of some of these startups from the day they were founded to where they are now, and how volatile things have been. Right, so they are very fragile companies, and sometimes their business strategies can change on a dime. Right, so the promoter says, "No, I think this is too risky." And the founder just pivots, and these pivots can sometimes destroy companies as well. These are things that are impossible to do in a large firm. So in many ways, some of these companies that actually sell out, or some of these promoters that do actually sell out, are not destroying the business, right? So the business still exists. It just exists in a different entity. So say suppose there is a online grocery company. The fact that they've created a pool of millions of customers who give repeat orders on a weekly or on a monthly basis. There are a set of warehouses and there are procurement systems. So if a large business house, which is wanting to build its own sort of basket of businesses, is wanting to buy them out, and they can fund them for longer. Working under that platform is fine, and some of them are like serial entrepreneurs, right? So you build that business, you create, you go from nothing to 2,000 times higher in 5-7 years, and then there is a bigger company and then you go and build a new business. So this attachment is something that again, which is that family business thing I was talking about, right? So the family businesses, the traditional large family groups, which would say that, look, let me create another arm, and then that nephew of mine can handle it, and then that component will be given to the second nephew of mine. And so the thinking is very different, and I don't think there's anything wrong with that.
So I think we have 5 minutes left, and so I'm going to ask a question and merge it with a question that one of our audience members has asked. So I'm curious what you think about. So let's say this is a growing trend, right? That as a percentage of incremental GDP, this is going to grow, that it's going to become a bigger part of the economy. I mean, if all of this is inevitable, I think one of the questions, especially, I mean, assuming that they're not going public and all of this is happening in this private company space, is what do you think the pros and cons of having them be private is? Like, so I mean, just from anecdotal evidence and reporting and all, there is a lot of evidence that there's less disclosure. There's some public accountability is something which is slightly different with these companies, maybe even problematic. Some of them, especially the ones who are doing a lot of social media advertising and stuff, are very litigious. And so there is kind of a big cultural differentiation in some senses of kind of protecting this fragility that they have between them, right? Even their employment practices, right? I mean, we've seen what happened with Uber and some of these other companies in London and all, right? That they kind of tend to do a certain kind of employment, they tend to a certain kind of PR blast kind of strategy. And maybe that's the nature of the beast, right? Maybe that's part of the quick growth, 5 years timeline, all of these kinds of things. But is that necessarily good business practice? I mean, I'd like you to take a bit of a normative stand on this if you have one.
Yeah. So the first thing is that almost by definition, they are operating in areas where there are no rules, right? So and then rules and laws follow these companies, right? So till you had shared mobility, it wasn't even a fair question to ask whether they are employees or they are contractors and whether they should get pension benefits or not, right? So the fact that you had those questions asked is something that is a natural, it's a process of, like, even in India, right? So how do you create a pension fund for them? So the Labor Ministry actually consulted with a lot of these shared mobility companies and food delivery companies as to or even e-commerce companies with a lot of delivery people, that how do we fund for their pensions? So these are things that will evolve, because you're creating new types of businesses, and therefore there will be some parts which are too small initially for anyone to pay attention to, but once they become large enough, then you start to create protective barriers. If the fact that there is a monopoly thing happening so that's comes with the domain. Whether they are public or private is actually not very important, right? So you are seeing big tech, lots of attempts to contain it, control it, maybe even split it up in the US, in China, so everywhere. And so that's a very natural outcome, right? Like the AT&T split that happened in the late 70s. So if you have a new business which becomes very powerful and it starts to manipulate that. So that is independent of whether it is public or private, right? The public versus private thing is if you are private, you don't need to, as a regulator doesn't need to worry about the public investor. See, all the regulations in the stock markets are to protect the small private investor, right? So if you're taking money in small bits from small savers, you need to treat them with a certain respect, and you cannot misuse the funds. And so in the private market, because it's like dealing with adults, right? So those regulations, because you know what you're doing with the money, so you don't need more regulation there. What this does do is, if a lot of wealth creation starts to happen in the private market, in many ways, the public market, the small saver, so they start to get left out, right? So
almost a Piketty argument in some senses.
I don't want to go there, but my simple thing is that see, there are a lot of pension funds investing in private equity. There are a lot of insurance funds. So it's not that the small saver is not directly involved, but you can say that the direct equity investor who may not be going through a pension fund is missing out on some of these things. I'm not necessarily of the view that, at least in a market like India, where the percentage of people investing in stock markets and the profile of people investing in stock markets are already the reasonably rich types, right? So it's not a Piketty argument in India, at least. But the very fact that in the US, SPACs are coming up, right? So the SPACs are a response to this. That in many ways, the public, because the number of listed equities in the US has been falling, right? Because there's been a lot of consolidation, and a lot of the funding and in entrepreneurial activity has moved to the private markets. So SPACs are an innovation to create incentives for these firms to sort of come and at least allow participation to happen. Same in India, and this is, again, as I said, India, funding and equity by itself is a domain of the rich. I mean, we all think we are middle class, but we are not, right? So it is. But there are now pre-IPO funds coming up, right? So people are launching funds which are AIFs, the alternative investment funds, which are allowing participation before the IPO happens. So this, I think the market will in many ways solve this problem, right? I don't think we need to be overly sort of interventionist in terms of saying that, oh my God, this is increasing wealth inequality, right? The fact that bulk of this PE money comes from university endowments, comes from pension funds and insurance funds, is itself a sign that the eventual owner, at least in the developed world, is participating.
Perhaps the next conversation is getting LIC and all of these guys to start investing them. But okay, so I think we're at the limit in terms of time. Thank you so much, Neelkanth. I think this is definitely, part of what CPR is trying to do is bridge this Delhi-Bombay gap, and you're definitely a big part of it. And we'd like to think that we play a small part in that as well. Just as a little bit of a plug, at CPR in October last year, we put out an issue on state capital relations, which covers many of the topics which Neelkanth discussed today in some depth, and we'll link that on our website if anyone is interested. But thank you so much, Neelkanth. This is a fantastic,
really fascinating.
And we're just looking forward to your next report.
Yeah, thank you. Thank you, Harish. Thank you, Rohit, for inviting me here. And thank you, everyone, for joining. Pleasure being here. And of course, we'll keep engaging in the future as well. Thank you.
Thank you.